Brand new equity peaks in the market as well as in our portfolios. Interesting to look at the Nasdaq. It made about a 3,000 point plus move down after the pandemic, and now it is 18 points about 18 points 100 points higher. And so 3,000 down, 3,000 up, and then plus 1,800 points higher. And it makes you wonder, where would this market be without the pandemic? Would it be this high? Would other factors come into play? Massive Fed liquidity may have pushed this market higher than it would have been had we not had a pandemic, which is very ironic. And the S&P is at brand new highs, massive reversal in gains with that Fed liquidity as well. The cash closed at new highs, the futures closed at new highs. Our strategies have taken advantage of this, and we'll take a look at that in the portfolios as well. You see Bitcoin on this chart. Watch that also. Haven't traded that in a while. Let's take a look at the portfolio calculator so you can look at the equity peak. All strategy excess 77. You see zero drawdown, and we are up on the month. Show you that. 39, 670, 125 drawdown curve. Snap back in the drawdown curve. You see we were down here at the end of the month, down there these worst case drawdowns at the end of July, and just screamed higher. So nice month, nice gains. Let's look now at the other portfolios. A lot of our other portfolios made brand new equity peaks on August the 18th. Stock index portfolio. Equity peaks here as well. 23,492.50 on the month. Recovering from July. Drawdown curve. You see it came and just clipped this worst case drawdown in July and then bounced right back. So that's why I say wait for worst case drawdown. You want to be able to endure it. You don't want to stop right there. It's like getting stopped out the lows if it happens, especially if volatility expands. You have to be able to endure that worst case drawdown. You cannot expect that to hold up forever. And so stock index portfolio 36 at brand new equity peaks. Now this one, after I updated it, it has to update the charts as I scroll down. So this one was only halfway into a worst case drawdown. So this is the this has more diversity, but it's more focused market wise. ES and NQ are the only two markets this trades. There's 36 strategies, and it's only right here, right at the halfway point of the worst case drawdown. It's hard to draw a straight line on here, but it's about $20,000 drawdown out of about a $40,000 drawdown, and it has bounced back, down 12K in July, up 22K in August. Nice gains on the year. Let's look now at the 200K portfolio, zero drawdown, 33,415 on the month after being down 10 to 87.50 in July. And this is an example of where it did make a worst case drawdown. The expansion, coronavirus volatility, this one was more sensitive to it, and so it made that worst case drawdown, and you had to buffer that. We also had expanding margins with that volatility, so you have to make sure you have enough capital, or you can roll back to micros in these situations, or to trade the 25K, 50K portfolio. If volatility gets too extreme, you can reduce the number of strategies. But it's important to have capital to endure worst case drawdowns, higher volatility based on worst case drawdowns, and then margins as well if margins go up. So that was what we went through with the 200K at the beginning of the year. It's since snapped back, and good gains on the month in this portfolio, on the 200K portfolio, and good gains on the year overall. Let's look at the 25K, 50K portfolio. More conservative from the perspective that it takes less trades, so it's slower, and it slows it down a little bit. Only 10 strategies, up 13,677.50 on the month. It's not, we're just kind of hitting singles and doubles. Gap continuation has had some big trades, but it's just consistent. And you see how these drawdown curves, study of drawdown curves is very interesting to me. And the drawdown curves this year have expanded a little bit, but they're not as bad as they have been in the past. And so you see the drawdown curve contract here and expands here during higher volatility, but still holding up worst case drawdowns really well. Having a good year, very consistent, pegging away at equity peaks this month, and a nice month overall, 13,677.50. And let's look at micro stock index portfolio. This one is up. Very nice gains, 39.91.25, trading just one micro on 52 different strategies. If you trade the full mini or the gold contract, you could be up 39.912.50. So it would be our top performer based on minis and gold, full gold contract, and mini E-mini Nasdaq, E-mini S&P. So you can trade, instead of one micro on each of these, you can trade one E-mini, and up 22.124 on the year based on micros multiplied by 10 for minis. And let's look at the drawdown curve. So it came down, had a sharp, rapid drawdown in July, and it has bounced back since. Right there, similar to these drawdowns. So good gains on the month for this portfolio. Let's look at the other three. We have the 100K day trade portfolio. It was at equity peaks on the 17th, was down $155 yesterday, and so 18,507.50 on the month. And there is the drawdown curve, comes snap back right here. Good gains on the month for that. And the last two portfolios are still in a drawdown. Liquid day trade portfolio, this one has room to run in a 52.21 drawdown. Here is the drawdown curve. This has lots of SR counter trends. SR counter trends have lagged, and so still up 10,783.75 on the month, 62,931 on the year. And let's look at the SR counter trends. The SR counter trends have lagged a little bit, like we were saying. Markets have had more V moves, fast, sharp, deep reversals, which are hard to trade in my opinion, because the time frame and the depth of those drawdowns are uncertain, and they change up quite a bit. Very strong first 3 months of the year, and then pandemic, just V moves all over the place, bouncing back a little bit in August. What I'm talking about is V moves. All of a sudden the market's chugging along like this, and then boom, it does a sharp move down, a sharp move back. And so typically, if the market's moving like this, you might buy a pullback in here or in here. But if it's going to make a deep pullback that just happens sporadically out of the blue, and it goes this deep, it's hard to capture. You don't know where that bottom is going to be. You have to have massive stop losses. So we're more used to waves. There's V moves. They're not that perfect. The waves in the market are not that perfect, but that's just an example of buying pullbacks, not just low volatility slam, low volatility slam. You know, when it does this, it runs away from you. There's no pullback, no pullback, no pullback, and then when it pulls back, it's deep pullback. And so same thing on the short side. Market's down. You know, instead of rallying a little bit and shorting it, rallying a little bit and shorting it, it's down, and bam, it soars higher. And if you're shorting there, it does this, and lots of mean reversion back and forth, much bigger than we are used to seeing. So the real benefit to all these reversals, V reversals, is strategies like gap continuation tend to capture these moves. We've seen really good trades in gap continuation this month, and brand new equity peaks. Let's go back here. There were some even better trades a couple of weeks ago. Big move up, big move down. You see kind of the V pattern that I'm talking about, and you know, you see this V pattern. It was locked into this, and I think we had some SR counter trends trigger on that day. Lost, but only lost 300. So when the SR counter trends are underperforming, strategies like gap continuations, strategies like Cobras have the opportunity to take advantage of this. A lot of our other strategies are doing really well, and so that's the benefit of diversity. You might have several groups of strategies. I have several groups of strategies in my portfolios. Trend, counter trend, strategies that use the NYSE tick, strategies that use the advancers, decliners. And so if one of these strategies is really doing poorly and going through this, the tendency for one of these other strategies to do even better exists. And so you get the balance there. And so the thing you don't want to do is you don't want to just start cutting out strategies that are underperforming only to see the strategies that are doing well start to do this, and the strategies that you cut out start to do this. So that's where the diversity occurs, and that's where we are on portfolio design. And so interesting analysis of the equity curves, the drawdown curves, and how these strategies work in a portfolio. It's important to understand that. Most traders want to try to perfect everything and make sure that they're trading all the perfect systems at all the perfect times, and you have to be a prophet to do that. And I don't believe that anyone is able to predict the future of the markets, especially these micro moves in the markets. And so having strategies that cover the entire base of what we know, there's always more over here that we don't know and that we're always discovering, but this includes the base of what we know, and we're always reaching, trying to discover new things and include new ideas without being biased and over optimizing our portfolio.